All right. Good afternoon, everyone. This is Rob Barnett. I want to welcome you to the BI Energy Exchange. I'm here in the office today. This is one of the first times I've done this meeting from here in the office in over a year. And look forward to having some of my coworkers in someday soon. As you can see, Patricio is here in the office. He's just sitting over behind my shoulder right now. So with that, we're going to talk about our research, latest developments, like we normally do on this call. And I think the very appropriate starting point is the big news out from the International Energy Agency yesterday. They did a very comprehensive look at what the future of energy markets look like if we get ourselves on a net zero emissions pathway. Interesting from so many different angles. Couple of things that I would note, quite obviously, very strong growth in renewables, very big pullback in oil and gas use, and much more muted prices over the long term. There's so many ways to slice it. We've got a lot of interesting thoughts, but I want to start with just the long-term demand outlook, and I want to come to you, Solly, first for that. So IEA sees a very precipitous fall-off in oil and gas production to hit a 2050 net zero goal. How realistic is that? Where are you at on demand these days?
Sure. Thanks, Rob. I mean, quite a bombshell report, if you will, from the IEA yesterday. And indeed, one of the main takeaways for me also was kind of the implications on oil demand and what they said about new investments in new oil and gas fields. And what they did say is no investment in new oil and gas fields will be required in this new net zero scenario that they brought up. And I mean, the implication for the oil demand really with this is that not only oil demand will fall quite a bit from now to 2050, and according to this scenario, that would be 75%. So oil demand would go down from the 2019 level of about 100 million barrels per day down to 24 million barrels per day, which is quite significant. But also, this no new investments necessary clearly indicates that the decline in oil demand starts now. So in the next decade, there will be a notable decline in oil demand in this scenario, which is quite staggering, I think. And it was definitely one of the on the demand side, definitely one of the key points.
Solly, I want to interject here. So, not only is a stunning reimagination of what demand could look like, but a big part of that existing production that remains to meet that demand increasingly is in the hands of OPEC member countries, as pointed out in the report. What do you make of that? Is part of this realistic that OPEC has more influence over the oil market over the next 30 years under such a scenario?
Yeah, I mean, in the very long term, I think it does make sense. But I think, I mean, in this report, they did come up with numbers as well. So they're saying that OPEC market share would go up from 37% to 52%. And I think, I mean, when you think about as demand falls, it will be the higher cost oil production that will come off first. And this smaller number of oil producing nations, mainly OPEC, are the lower cost producers. So it makes sense that in that midterm region, it will be OPEC countries kind of regaining that market share. But I mean, this may sound like a good thing, which, I mean, I guess it is. But when you think about this scenario specifically, it's not so great when it's really happening amid this really significant oil demand drop as well. So in this scenario, they are envisaging $24 a barrel of oil price by 2050. I mean, we're talking about a huge strain on the fiscal budgets of these nations. And I think there are two important points I think to be made in terms of what this may mean to some of these OPEC nations and some of these NOCs. And one is that this more reliance on OPEC and these other producing nations, with potentially falling oil and gas revenues, brings this supply security risk, as you alluded to. And secondly, the structural reforms in these countries really are necessary quite urgently. I mean, I think part of the purpose for this report is to really highlight that urgency to these countries, that they really need to accelerate diversifying their economies from oil and their reliance on oil, and they need to invest in low carbon energies. And I do want to mention that some of these countries will kind of evolve and will have the kind of capital to do that, but some of them may not. I mean, coming out of the pandemic, they are already fiscally quite strained, so they don't really have a good starting point for that.
Very interesting, Solly. Hang on, I think we're going to come back to you, but let's bring on Will Harris. So, Will, Solly just kind of framed the big picture narrative for OPEC producing countries, some of the NOCs. How's a company like Shell, BP, some of the energy majors approaching this? I think you pointed out to me the other day that in Shell's annual report that they see the potential for a 55% reduction in traditional fuels by, I believe, 2030, which is a pretty aggressive number, perhaps aligned with the IEA net zero number. Tell us how you're seeing it, and what are the energy majors doing about this kind of question?
Yeah, thanks, Rob. So I think it's important to point out first that the IEA has historically been quite oil industry biased. So this report really landed with a bit of a bombshell impact on this dramatic change in their view for the long-term oil market. And given that, it's understandable that the Euro oil majors are not exactly aligned with this outlook. And however, as you mentioned, their strategies are pivoting. One of the most important takeaways from the report, as Sally mentioned, was that no new investment in further oil and gas developments is required in their pathway. Now, that does not include existing oil and gas, because of course you have roughly 4% year-over-year decline in reservoir decline in oil production globally. So there will be continued investment. And what we are seeing from the European oil majors is a very disciplined approach on the investment side. We still think spending will be flat or even marginally below last year this year. But also for the energy transition, we are seeing an acceleration in plans. We are seeing increasingly ambitious renewable power capacity targets come through from BP and Equinor and Eni and with Shell the only one to not disclose a target. But we're seeing accelerating M&A as well. So I think the writing is on the wall here for these majors. We're seeing declining reserve life, declining reserve replacement. But I think as far as the current context within the oil major space is that they know that oil demand will decline over the long term, but this is still where the divisions where the vast majority of their cash flow and profits are generated from, and so they are in no rush to be fully divesting or taking any dramatic portfolio actions in the near term. We expect that to unfold more over the next decade and longer.
Will, in terms of reporting the financials for the energy majors, formerly the oil majors, I suppose, how many of them are actually breaking out financial reporting from this segment at this stage?
So there's only one oil major, global oil major, reporting a fully broken out renewables division currently, and that's Equinor. However, I expect more to begin to do this near term. You also have Eni, which partially breaks out their renewables, but it's bundled in with their retail gas and power segment, so it's not as clear. I expect moving forward, we're going to see much more in-depth financial disclosures on renewables as these divisions grow. Most of these divisions are going to 5x or 10x capacity in the next 5 to 10 years. So up to essentially utility level scale. So they will be meaningful over the long term, just not right now.
Yeah, I think the IEA basically is expecting a 4x increase this decade in wind and solar capacity additions in their net zero scenario. So there's a lot of potential demand out there for continued investment. Clearly, some of it's going to come from the energy majors, but I think that it's also going to be going head to head with some of the companies that Elchin looks after. So Elchin, you saw this big report. Elchin is our senior utilities analyst. As putting your utility hat on, what do you make of the IEA coming out and having such a big transformation scenario publicly now? And you know, we've talked about it in the past, but I think we're going to see increasing competition between the oil industry and the utility industry. Who's going to win in that battle, Elchin? Oh, Elchin, I don't hear you. I think you're muted.
I think everyone is going to win, Rob. Utilities are welcoming that competition. They do have certain advantages over oil majors, but the key thing for utilities is at the moment is the rising cost of equipment rather than the competition from energy majors, because there's enough capacity to be developed by everyone. Yes, in some markets the competition is really tough, and that does pressure the demand. And if you look at the utility strategic plans, they do expect the returns on renewable projects to come down. But as you said, it's 4 times increase. IEA is probably going to be wrong. It's probably going to be 6 or 5 or higher, or maybe slightly lower, but the directional they're correct. And I think utilities do welcome that. And my sector will be a net beneficiary from energy transition, way more than Will's oil majors, which still have a lot of legacy business to deal with.
Well, Elchin, one of the other pieces of your portfolio, in addition to the utility component, is you're increasingly looking after some of the hydrogen research we've been rolling out here at Bloomberg Intelligence, and you've actually put together a theme basket around the idea. I don't think hydrogen actually got a whole lot of focus. It's there, but it wasn't a big part of the highlight coming out of the IEA report. So, what's happening with hydrogen as you see it, and which names are most interesting for thinking about that aspect of the energy angle right now?
I think hydrogen unfairly hasn't been, the centerpiece of this thing alongside with wind and solar. You can't decarbonize a lot of sectors like transport, for example, without the hydrogen. You can't decarbonize heating without hydrogen, and batteries won't help you there. So in terms of companies that are leading the sector, there's a few. In the US, there's Plug Power. They're already big. They've been around for a long time. In Europe, again, we've got Nel in the Nordics, and we've got ITM Power in the UK. These are very long established companies. They have a lot of IP. They do produce a lot of their components, and a lot of them, like ITM, for example, they have Linde as an industrial partner, because all of these hydrogen companies, they're good at making the stacks, but they're not good at handling all of the projects, the turnkey projects. So that's why they need partners. I do think hydrogen is central to energy transition, and we're going to see more emphasis on it in the coming years.
I want to turn it over to Patricio Alvarez, who covers some of the gas utilities here in Europe. Patricio, I think we've talked about this before, but I'm very curious, especially when you see something like the IEA Net Zero report, what's the potential for hydrogen in the existing gas network? How much hydrogen can you blend before it becomes a problem? And which companies are really looking after this as part of their future narrative?
Sure, Rob. I think in broad terms, I align to what Elch is speaking about as how hydrogen seems to be understated in EIA's provisions. On the other hand, well, let's say the adaptation to sort of blend hydrogen with gas, it's still in early stages across nat gas utilities in Europe, and that's given because they've been investing in different parts of the value chain to see what's the best exposure to this, whilst also trying to mitigate the stranded asset risk because they're huge. They have a huge exposure there, and if you take EIA's provisions, natural gas consumption will drop quite significantly, presenting a major risk for these guys. So they are pushing to convert their pipelines to blend hydrogen and gas, and there's pilot projects that have accepted anywhere from 2% to 10% without major investments, which is positive. But again, as I said, it's still early stage and quite exploratory.
Yeah, I think it's very interesting to think about the hydrogen piece of it. Our colleagues at Bloomberg NEF had a presentation out just the other day looking at, well, what's the break-even cost for doing hydrogen in things like the steel industry? And they showed that a hydrogen would need roughly €70 a ton carbon, I believe, off the top of my head, which we've seen that carbon prices come off a little bit this week, but we're not too far from that level. So maybe you're going to start to see the carbon market drive some of the industrial applications of hydrogen. And on that front, Will, I want to come back around to you on this because, first of all, I'm curious to know how much the oil majors are talking about hydrogen these days. Is it something that they're excited about? And then also just frame this broad discussion we're having around what's happening with spending in the space. You put out a report looking at what they're doing with their cash flow, capital allocation, return to shareholders, potential M&A activity. What are they doing on hydrogen, and what are they doing broadly with their spending portfolio these days?
Yeah, thanks. So quickly on hydrogen, each European oil major is involved to some extent in hydrogen projects, although I would characterize their exposure as relatively peripheral in the context of their overall energy transition strategies. Most of these projects are located in and around the North Atlantic. You have a pretty large European Union target of 40 gigawatts of electrolysis capacity to be met by 2030, and there's a few large-scale projects under development, like Teesside in the UK, and several other ones in Germany and the Netherlands. So it is moving ahead, and but I wouldn't say that it is central towards these oil majors' energy transition strategies. It's much more peripheral or complementary. And on the capital allocation side, we're seeing a pretty strong year unfold here for the oil majors. This is clearly as a result of much more improved commodity pricing backdrop, but also given the immense spending cuts that we saw last year, down 40% year over year, big operating cost reductions as well. We're seeing a lot of divestments come through to bring down that excessive balance sheet leverage that many of these companies were struggling with. We saw big dividend cuts from every European oil major other than Total. We've seen share buybacks all halted through last year. So what this is resulting in is significant free cash flow generation from these companies. We see free cash flow yields of 10% or more, which means that there's a lot of cash to be deployed. Now, management teams and boards are under increasing pressure from shareholders to augment their returns. That's either through dividend recovery, which we see as continuing to be marginal. We've seen very small dividend increases from Equinor and Shell, but we don't think there's going to be that's going to form a major component of cash allocation. Buybacks are another area. We've seen BP as the first oil major to resume buybacks in 2Q. We think we could start to see more of that through year end. Buybacks are obviously a much more flexible way for boards and management teams to distribute cash to shareholders. But I think probably the most important area for these companies is going to be continued deleveraging. Nearly all of the European oil major peer group has said that debt reduction is a strategic priority. But then beyond that, we could see continuing M&A in small to mid-size M&A, not large cap consolidation within the energy transition space, and mostly directed at renewable power capacity projects. We still see a lot of these companies have very big and ambitious renewable power targets, 2025 through 2030, reaching that utility level scale, almost as I mentioned earlier, and they're going to have to acquire projects to get there. This is not going to be an organically driven achievement, and we're seeing it. We just saw recent announcements from BP for a 600 megawatt solar project in Australia. So we expect the energy transition M&A front to be pretty active with this excess free cash that the group will generate this year.
Speaking of clean M&A activity, Sally, we had a big announcement in the past week on that from Repsol. You've written on that, and tell us what you're seeing from them. I think Repsol is one of the more interesting ones on the energy transition, so share your outlook.
Sure, yeah. I mean, it wasn't too much of a surprise. I mean, we know Repsol is definitely one of the more ambitious within the peer group, and they already have a target to double their capacity by 2030 and then double it again by 2035. So, but this acquisition of was for them to expand beyond Spain and Chile. So now they have exposure to the US with this acquisition. So it was just a natural kind of expansion for them, because we knew that parts of their expansion would be organic and part of it would be inorganic through acquisitions. And I should say, I mean, one other note that we wrote on them is the potential IPO and of their renewables unit, which apparently they may. I mean, this is all kind of reported by local sources, but it seems it may be delayed by a couple of years. Again, this could have something to do with the fact that year to date, oil has done relatively well, clean energy in comparison, not so well, but the long-term performance, when you look at it perhaps in a 5-year time period rather than just 5 months, is much different. So I suspect that we will eventually see that IPO, which will be really good for the value visibility for their renewables unit as a separate unit, as they kind of gradually transform the business away from the legacy oil business into more and more renewable power generation.
Elchin, I want to come back to you now and hear your thoughts on uses of cash in the utility space. What are we going to see? More dividends, push into green investment? What's going on there from your perspective?
Luckily, utilities have deleveraged way earlier than oil and gas companies, so that's not really a focus, apart from a few companies like E&Ps, for example, or Centrica, for whom deleveraging, it's not really deleveraging, but they have huge pension liabilities which they're trying to meet through asset disposal gains. So that's, most of utilities don't worry about deleveraging. If anything, some of them are underleveraged. So the key focus for the sector is increase in capex. There's a massive increase for a lot of companies, partly because of green stimulus, partly because of the acceleration in green energy transition in general. And I think the dividends are going to take the backseat. Some of the companies are going to keep their payouts, so the dividends in absolute terms will rise, but a lot of the companies, I suspect, will slightly reduce the payout just to make sure that they accelerate capex growth, because now it's the right time to do that. So that's how they differ.
Very interesting, Elgin. I want to switch gears with our last few minutes here and come back to Patricio. Patricio, very unrelated to the energy transition and everything else we've been discussing, but you have a couple of reacts out this past week related to your Latin American E&P coverage, and particularly looking at what's going on in Colombia. Can you break it down for our customers? What's happening there, and how is it going to affect some of the companies that are active in the region?
Sure thing. So just to briefly summarize, there's been protests across Colombia since for 3 weeks now, starting in April 28th, just repealing or opposing the introduction of a new tax reform, which would tax lower income segments of the economy. The tax bill was repealed, but nonetheless, protests are still ongoing for now 2 weeks, and they've become a bit more violent, and they've caused blockades across many roads. And this is impacting most of my oil producers in the region, which, with the exception of Frontera Energy, have all announced that these may impact their longer-term production targets. How do we think this is going to play out? We are obviously not certain, but we think, just given the scale of the blockades and the economic impact that this has on not only the companies but all of the economy, we don't expect this to last for more than a couple weeks from now. And if that's the case, I think the recovery for most of the LATAM E&Ps will still be on track. If it moves more into June or July, then we're talking about severe impact to the companies. But as I said, we don't expect that to be so extended.
Okay, thank you, Patricio. I want to thank everyone for calling in today. Everything we've discussed, you can find the underlying research on BI Go on your Bloomberg terminal. Reach out to any of us if you have follow-up questions or you have topics that we didn't get to today. Hope everyone has a great rest of their week, and we'll talk to you soon.